This video on liquidity is one in a series of short videos to introduce you to the 5 criteria for farm financial analysis as part of the Farm Pulse financial management curriculum. Sometimes you need cash in order to make purchases for your farm business, pay operating bills, make debt payments, pay for family living expenses, or others. If you don't have a ready source of cash on hand, you need something you can sell easily to get cash. This ability to get cash for immediate expenses is called your liquidity. It measures the ability of your farm to meet financial obligations as they come due, without disrupting the normal operations of your farm business. Liquidity is your business's cash reserve. You need liquidity in order to withstand unexpected needs for cash, such as adverse weather events, price conditions that may result in economic losses, or for new investment opportunities. There are 2 ways to measure your farm's liquidity position: current ratio and working capital as a percentage of your farm's gross revenues. One liquidity measure is current ratio, which is your current farm assets divided by current farm liabilities. The current ratio measures the ability to pay operating bills and the annual portion of long-term debt in the current year. Current ratio also measures whether the current farm assets listed on your farm balance sheet, if sold tomorrow, would pay off your current farm liabilities. The second liquidity measure is working capital as a percentage of your farm's gross revenues. This calculation is the farm's working capital, which is calculated as current assets minus current liabilities and divided by your gross farm revenues. Working capital is a measure of the amount of funds available to purchase inputs and inventory items after the sale of current farm assets and payment of all current farm liabilities. It tells you the operating capital available in the short term from within your farm business. Working capital to gross revenues ratio measures your farm business's working capital to the size of your farm business. A farm that has a strong liquidity position is better able to have cash available when it needs or wants it, while a farm with a weak liquidity position will likely have trouble making purchases, paying bills, making debt payments, and paying living expenses. In extreme situations, assets that are otherwise would not be sold are sold to generate cash, thus disrupting the normal operation of your farm. You need to determine your risk tolerance and manage your finances to maintain the desired liquidity ratios for your farm business. More details on farm financial statements and the liquidity ratios are available at farms.extension.wisc.edu.